Thanks for staying with us. Of course, you're still watching Finweek Money Matters. Remember, this is the show that helps you manage your finances. There's been much speculation on when the US Federal Reserve will start to increase interest rates for the first time in nearly a decade. Joining me in studio to discuss what the Fed is likely to do in the coming months and the implications for the South African economy is Jean Pierre Verster, Analyst at 361 Asset Management, and Lesiba Mothata, Chief Economist at Investment Solutions. Gentlemen, thanks so much for your time. I'll start on the outside. Lesiba, I take it that definitely you were listening to what Fed Chair Janet Yellen said during the course of the week. What did you take away?
So the bottom line is the Fed is removing this uncertainty that is in the market, and they made it very clear that they'll hike interest rates in December. It needs to happen because they've been talking about it all year.
Yes.
And there's a credibility issue that has begun to creep in. Different Fed governors were talking in different languages, and now it seems like they're very resolute in their mind that they'll hike interest rates. Although there's disappointing incoming data, particularly that of GDP, which was 1.3%, it's quite a disappointing number that we have seen recently. There are some, however, signs that output gaps are beginning to close. So when you get output gaps closing, it means inflation is likely to rise going forward, and the Fed actually is well within its reasons to hike interest rates now. It's going to be quite a huge outcome because we haven't seen interest rate hikes in about a decade.
Yes.
So it's a good thing that we'll see interest rates going up, I think.
Lesiba said the Fed said December. That's definitely on the table. But that economic data that he mentioned, apart from GDP, we had the durable goods numbers. Would it be justified for them to say December, let's go ahead and hike?
Well, most economists are expecting a hike now in December. But if you look at the Fed fund futures, that implication is only a probability of 50%. Because of exactly that. The market is saying, well, the economic data is so bad,
yes.
It's a 50-50 chance whether they'll hike December or not. And the problem is, and that's the reference that was taken away now in the past week, that the global economy is slow. Actually is in not a tightening phase, but in an easing phase. And it's the US domestic economy that's strong. So the US domestic economy probably can weather a hike in interest rates. And it might actually be a good thing because it's good for the banks from their endowment effect. We've seen labor rates increase, so the consumer is in a better position. That means more aggregate demand, so it needs to be balanced by maybe tighter monetary conditions. And the only reason we haven't seen a hike is because of the global economy. And with that reference being taken away in the latest statement, it implies that the FOMC is more inclined to a hike, yes, good for the US economy, but the big question mark is still what does that mean for the rest of the global economy and emerging markets in particular?
Well, we're going to definitely touch on that. But Lesiba, let's talk about other institutions, the World Bank, the IMF. They've said, wait, maybe you're just not ready. You're not ready to do this hiking thing just yet. Last time we got a very strong sense that China was a very big contributing factor to why they didn't.
Decision,
So now how do you balance the two?
Now, so these supranational institutions, IMF, World Bank, one needs to take what comes out of there, we need to think about it, what they say. They look at aggregate numbers and they talk in sweeping statements. So when they say that the Fed shouldn't be hiking because there should be easing monetary policy elsewhere, one needs to consider also what other people had said. So at the same time, when they had their annual meeting at the IMF, there was a paper that I think is very influential, which was released by the Group of 30, which include Alex Weber, who was at the ECB, and Trichet. A quartet of former central bank governors came out and said, you know what, we can see the effects of QE has not been desired. Whatever you do, it's not going to change the outcome. What is likely to happen here is that the debt binge of governments throughout the world are beginning to cause a seed of problems going forward, and what we need to have here is just normalizing interest rates. I think Yellen has listened to that, and IMF, etc. I see that their expectation on economic growth is down on an aggregate basis, but the US numbers looks better than the rest. So the US is a different situation. As we have discussed here, wage growth has arrived. It's a brighter spot throughout the globe, and what needs to happen is to tighten policy. They should actually have begun a while back. I'm a little surprised that it hasn't happened before. And these quartet of central bank governors are, in a way, screaming at the background, saying the consequences of this policies we don't understand. It is uncharted territory. What you need to do is, whether it's working or not, hike rates, which I think should happen.
What we're also screaming in the backgrounds is us as emerging markets, we've taken out debt, and if interest rates go up, it's going to hurt for us. So Jean Pierre, us as South Africa also falling into that emerging market basket. What does this mean?
Yes, unfortunately not good news to me, Shaw. If the US interest rates are hiked, it means probably strength for the dollar. It means that where the dollar has been used as a funding currency for the carry trade, borrowing in dollars but investing in emerging market currencies, including in rand-denominated sovereign bonds, it could mean a reversal of that. Outflows out of emerging markets back to the US, a weakening of emerging market currencies. And then to add more fuel on that fire, we also have weaker commodity markets, firstly from China importing less commodities. But secondly, if the dollar strengthens, it's a better store of value itself, and people will look to the dollar as a store of value rather than commodities. So a double negative whammy for commodities, and therefore very bad for emerging markets who are the primary exporters of commodities. That would put pressure on emerging markets' local economies. Maybe then those central bankers will also need to raise interest rates in those emerging market economies to try and defend their currencies and the inflation rate targets that they have. So this could become a self-fulfilling process where the weakness could be quite severe. And we've seen that already in the rand, but there could be even more to come.
Even more to come. Central banks in other parts of the world. So it brings us quick to the question to what is our central bank going to do? And maybe let's also talk about some of the action we've seen in the other developed markets.
In the developed markets?
Yeah, like in terms of what Mario Draghi has hinted to happening, the Bank of Japan.
Yeah, so they'll continue to ease for good reason, because there's deflation that's creeping up in Europe, Japan. They've been a perpetual QE. They'll continue in that light. Just one point also just on the emerging markets. You know what? These currencies have been beat up. There's some form of efficiency in markets. So while we've been expecting this rate hike, it's well telegraphed, and I'm in the camp where emerging markets are actually of interest, given what has happened in the last few months. Brazil has been beat up in terms of currency performance, north of 30% depreciation. So is Russia, so is Malaysia, Indonesia, including our own countries. So from that perspective, there's actually could be value just on valuations in emerging markets. It's interesting, both on stocks, both on currencies, and we're beginning to see our managers beginning to dabble into some of the emerging markets from that basis. Notwithstanding what's going to happen in developed markets, easing out of the ECB, easing out of Japan, now easing out of the People's Bank of China. It's all liquidity in the markets, which is good for stocks. So I expect emerging markets to rally.
I want to come back to you again, Jean Pierre. I definitely have a question for you straight after this. But how are we faring if you look at South Africa and what they're doing in their central bank moves versus other emerging markets? You mentioned Brazil and Russia, and developed markets are easing. So what are the other ones doing?
It's a tight situation for the SARB. The governor spoke 2 days ago in his speech, and he talked about how inflation expectations are anchored at the upper end of the inflation target range, 6%. CPI in Q1 is likely to go up above, say, 6.5% because of base effects. You know, we had lower oil prices and petrol prices previously. That's going to come through. So we're in a situation where, if you look at the entire emerging market basket of countries, are actually on an easing phase. South Africa is on a tightening phase because the effect of the throughput of higher or weaker currency into CPIs is likely to come through. And that is a concern. So we're sounding hawkish. Despite what's going on in the underlying economy, the SARB actually has little room to move other than to be hawkish and hike interest rates. So if the Fed does a December one, we can be rest assured that in Jan, we're likely to see our own central bank follow through.
Jean Pierre, we've also seen companies that are listed on the US stock markets come out with their numbers of late, and they've been flagging the stronger dollar. You were speaking about this and what this means for us. Is that not enough to convince the Fed otherwise, saying we're under pressure, the strong dollar, it's going to hurt us?
Well, they are the central bank to the US, not to the world. Some would say they are maybe to the world if you say that the US dollar is the reserve currency of the world, but they need to look at the US economy first. And if they do that, the data shows that the US economy has been strengthening, that price inflation in some sectors, especially in the labor markets, is increasing. And they have held so late in the whole process of hiking because of these international reasons, which have now come to a point where they can't delay any hikes further because they are at the zero bound. It means if there's any other crisis coming, they can't really cut rates further. So they need to get away from zero to have some ammunition if they need to cut again in future. So no, they have no reason to not hike because of the rest of the world.
And on a sector basis, if we are looking at South Africa, all of this is going to happen at some point or another. What should I be doing in terms of investing?
So the investment implications, I would say, is you probably want to invest in companies that have a cost base in emerging markets, but that sell in developed markets, but outside of commodities. So whether it
that sounds like a lot to tick.
So whether it be in tobacco,
okay,
in alcoholic beverages, in luxury goods, we've got quite a few of those companies on our local exchange that other emerging markets don't have. Quite a few companies do have their cost based in emerging markets. I can also think of a furniture manufacturer, for instance, but they sell in developed markets. Those are the type of businesses that will see their margins expand as they sell in dollars but pay their costs in other currencies. And they will do much better than the likes of commodity producers that might sell in dollars, but the actual product that they sell, that price is coming down in dollar terms, even though their cost base is in emerging market currencies. So a tricky situation for investors to traverse, but there are still opportunities out there.
Yeah. We've got about a minute left. Festive season is around the corner. I'd like to find out from the two of you, what do you think Lesiba and his team is going to do in terms of interest rates? Are we going to be looking at one in the next meeting? Lesiba?
Not this meeting, in Jan. He will have to hike. He'll sound very hawkish,
okay,
but he can't hike now.
Okay, so just when we have to go back to the schools and work, that's when
unfortunately,
we have, okay, so we must be very, very careful during this festive
season. And how you
season.
spend in this December, because things are tight, hey? Notwithstanding what could happen in fiscal policy next year,
Okay.
you can get higher taxes, both on the corporates and on the individual.
Okay. In your view, Jean Pierre?
I'm glad I don't have a job at the Reserve Bank. Very tricky, because these the fueling of inflation is because of exogenous factors, mostly because of the rand. And that means that a hiking of interest rate doesn't really speak to that. It might dampen domestic demand, but it should not defend the rand. The rand could continue weakening even with a hike. So we probably will see a hike, but whether it will stem a weakening of the rand and a stemming of inflation because of that, I have my doubts. So I think there are tricky times ahead.
Tricky times ahead, gentlemen. Thank you so much for joining me and giving us an understanding of what this US interest rate hike would mean for us as South Africans. Thanks to Jean Pierre Verster, Analyst at 361 Asset Management, and Lesiba Mothata, Chief Economist at Investment Solutions. That's it from us for this week's edition of Finweek Money Matters. Do remember that you can go and get yourself a copy of this magazine. Yes, it's available at your nearest store, or you can also go online and have a look at a copy of that magazine there. Well, until we see you again, same time next week, have a great weekend.